us tonight. We are just going to, if you don't mind, give a few people some time to join. I believe there is quite a lot of news, especially for those of you in South Africa. Our first night of lockdown. So if you don't mind, we will hold for another 2 or 3 minutes while we get everybody online. Thank you. Start. I see that we are climbing up to 100 odd participants. So ladies and gentlemen, thank you so much for joining us tonight. There is so much going on in our world. And starting off on a very serious note, we certainly are in a crisis at the level of which we probably haven't seen for 75 years, probably since the Second World War. And I think that it's fantastic that you are joining us tonight. We certainly are being tested, and it's going to be very interesting to hear from our panel tonight how resilient our medical really is. We have been talking about it. We've been guesstimating that we are recession resistant. This is the ultimate test. So without further ado, I'm just going to introduce some of the panelists here tonight. If we can get onto the correct presentation, that would certainly help. Attendees, can you see the lead slide introducing Med27? Panelists, can you see the lead slide?
No, not at this stage. You're up.
Fantastic. So again, our purpose of tonight is first of all to take you through some of the, obviously the history of OrbVest. I know that many of you looking at the attendees here tonight are existing investors, so thanks again for joining us. But there are certainly a few new guys, so if you don't mind, we will do a little bit of an intro on OrbVest. Unfortunately, I need to start off with a little bit of the legal stuff. Just bear in mind that this is a marketing presentation. We are certainly not giving you any specific advice. While we are a reliable source of previous information, a lot of the information that we give you is forward-looking, and obviously there is risk involved in investing on the basis of that forward-looking data. Just to give you an idea of the basics of how we operate in terms of the legal framework, every asset that we buy is effectively listed into a separate entity, and it is a tradable security. Our South African operation, and many of you deal with us in South Africa, where we have a team of consultants. We have applied for a Cat 2 license, and OrbVest SA is currently trading as an FCA juristic rep underneath Van Wealth Services. In the US, for accredited US investors, we are open via 506C, which we filed under, and that is the basic framework, and that's the unexciting stuff over for the evening. So basically, guys, what is OrbVest all about? Well, we're a global real estate company, and we invest only in stable, income-producing assets in America. We have a hyper focus on medical commercial buildings, and I think what you're going to learn tonight is that the medical commercial building sector is very, very large. And within that sector, there's good and bad. And so what we've been trying to get to grips of over the last year is what is the right place to be within that particular sector. So we call it a focus within a focus, or a hyper focus, and we're going to learn a little bit more from Hennie here tonight all about that. The team, for those of you who haven't been here before, the international guys, Martin, who is online and coming to you from the USA tonight, and our CEO, and of course, the man who makes it all happen, the man with the magic, Mr. Machiel Lucas. I will give you a bit more information as they come online a little bit later on. Here in South Africa, Lo and myself look after the operations. A little bit more information about Lo. He is our CFO. He has done a good deal of work with the Sale Group in the beginning of his career, where he served on multiple boards, and later on joined MSP, which, as you know, is a very large listed property group, and he has spent a lot of time in that sector. I'm best known, I guess, for my part in founding Private Property, the web portal for real estate in South Africa. But I guess I've spent much of my life in real estate, having tried my hand at commercial and industrial and residential development, including 30 years ago building a medical center in Durban, South Africa. Of course, one of the big differentiators is that we realized very early on that we're dealing with other people's money. And while the team under Machiel, the deals team, go around America looking at buildings and looking at opportunities, they do get emotionally attached to opportunities. They have to bring those opportunities and have them sifted through the investment committee. Over the last year, I think we've got significantly better at being able to understand what we're really going after within that medical sector. And that has come from the leadership of the two new members in the investment committee, specifically David van Drach. The guy on the top right-hand side has been the head of credit of several banks, including Investec and Rand Merchant Bank. At Rand Merchant Bank, he co-founded the private bank and also was instrumentally involved in setting up RMB REIT and Ashburton. We're very, very lucky to have him involved. And Alan, if he's online tonight, hates to be Mr. Fix-It, but ultimately over the years, when an institution has taken on a property that's got into trouble, Alan has been called in to effectively turn that development around. He's got a multitude of skills, including obviously a substantial period of time in the construction industry. We'll talk about Hennie a little bit later on, but without further ado, I would like to bring Martin in, who is, of course, hunkered down in his home in Westchester, New York. Martin, are you available and can you speak?
Absolutely, Justin. And I'd just like to say welcome to all our investors from around the world. I'm talking to you, as Justin said, from my home, which is just outside of Manhattan in New York, and certainly under very crazy circumstances, especially with myself being in lockdown and so many other countries joining, and especially South Africa joining the list tonight. I just want to mention that from a US perspective, I can offer some hope to everyone. And that is that the moment the lockdown begins, what you'll see is a shift of focus with most governments and individuals around the world immediately moving into solution mode and thereby looking for ways to exit the lockdown and how to protect their economy and also their individuals within the country. I'm sure everyone saw last night the $2 trillion aid package that the US government launched, which is just an incredibly large number by anybody's stretch of imagination. So in summary, Justin, and to all the investors tonight and all our customers from around the world, I just want to say that I'm fine, my family's fine. The kids continue as normal as they are attending school via online learning tools. And most importantly, to our investors, OrbVest continues to be at this stage unaffected, with all our employees working from home and no disruptions being experienced. So Justin, the next thing we want to talk about tonight is really OrbVest, our journey and where we're going. So as you mentioned, that we're a real estate company, that we invest into stable income producing assets in the healthcare niche and only in the USA. One of the things that we like to focus on is the fact that as we continue to acquire buildings one by one, our portfolio is growing. It's now over $300 million. We will continue to acquire between $100 and $200 million of real estate per annum, and we'll move towards our goal of getting in the short term to $1 billion under management. This is a snapshot of the portfolio, which really just shows and highlights the early days from when my team were acquiring real estate in the USA, and now it's evolved over time. As our equity increases, we now are raising equity from over 10 countries in the world, and that continues to also grow. And so as the equity increases, the value of the real estate is increasing. And so you can see that we're moving into the phase of trophy assets. And these buildings, I just want to give you a little bit of insight. These buildings are in locations where there is population growth. These buildings are multi-tenanted, or otherwise they have very strong tenants in place. They offer tremendous resilience to any kind of shocks to the economy. They are well known, these tenants. They are profitable. And as we like to always say, you know, healthcare related practitioners are very profitable tenants who have probably been in the same location for up to 10 years and will probably remain there for the coming 10 years. So all around, we raise the money globally. We acquire these assets in the USA. They are resilient, they're cash generative, they offer the great yield, but without the associated risk. So this is a picture of Medical 26. We'll be talking later tonight about Medical 27. We acquired this fantastic asset in Texas, in Dallas, right next to the Medical City campus. And this building is multi-tenanted. It's very well known. We closed this exactly 1 month ago. When we did, we actually received tremendous publicity in the United States across all the media channels, given this kind of trophy asset. And again, we really are here to make sure that our number one criteria is achieved, and that is the preservation of clients' capital. So we seek assets, we always say in the company, that will future-proof your income. And this certainly is one of those assets that we're very proud of. So with markets in disarray and people being so concerned about their returns, the one thing that we want to highlight to everyone is, what do you do in this crazy time and where do you put your money? And as you can see, that we have consistently only acquired properties in the medical niche that will generate between 7 to 8% minimum cash on cash. And then when we sell the property, we also make a profit known as capital appreciation. And so our goal is that we will generate on a yearly basis 7 to 8% cash on cash and 12 to 17% total returns per annum once the building is sold after 5 years. We hold the assets for 5 years. And you can see here the consistent performance across the entire portfolio. And we believe that we are extremely well positioned to see continued growth in the portfolio and similar returns. And you will certainly see tonight why we believe so strongly in the sector and the kind of assets we're able to bring to people around the globe who are all seeking the same thing. We're never going to shoot the lights out. We don't promise that. What we say in the medical niche is you're just going to generate for yourself and your family good, consistent returns.
Martin, thanks very much. That's a great insight. If we can change over to our chairman and co-founder, Mr. Hennie Bezuidenhoudt. And for those of you who don't know him, Hennie has spent the best part of his life, 27 odd years, in the commercial real estate space with a focus on medical office buildings. He has a very interesting career and involved in very many different things, including farming of game, the supplying of meat, organic meat to Woolworths, and many other things that he doesn't like us to talk about. But I think more importantly, his Benchmark Group is one of the biggest independent owners of medical real estate in South Africa. He owns some very interesting hospitals across the country, and he has been for the last 13 or 14 years investing overseas and looking at real estate opportunities. So we're very pleased to have you with us tonight, Hennie. I'm glad that you also are unable to travel. So you're stuck in South Africa and can join us on this webinar. So Hennie, are you available and online? And can you talk to us a little bit about why the US, why medical, and why medical technology?
Thank you, Justin. Yes, I think we would like to very briefly talk about the three why the US, and then why medical and why healthcare specifically. If we look at the US, it's a big country. Our focus is the US, and our focus is in states, US, with proper and real population. Out of our experience, it's very clear to us that, you know, if there's population growth in a city, in a suburb, the value of real estate will go up. And this is the cities, the states that we try to focus on. It is in the right-hand middle. It is the New York area. You can see their population growth of 16.7%. Then we go south to Georgia and Florida, 8.6 and 13.3%, and then Texas at 14.1. The areas that we would like to expand to in the nearby future is Denver and the states around Colorado, in that area where there's also very strong population growth. This always obviously must also you know, be relevant or important in terms of economic growth, and those states also experience that. The other thing why the US is very attractive to us is that about 93% of all citizens in America is covered by health insurance, which obviously is very important because payment to our tenants is secured through the health insurance. Why medical? In these uncertain times and difficult times we're in, stability was always our first priority. And we are in a very interesting industry where there will always also be change in the future. But the big question that one needs to answer for yourself is, will there be demand for healthcare services in the future? Will there be a growth in the demand? Will this demand be sustainable? And the answer to all these questions, with a huge aging population of almost 100 million in America, is absolutely yes. We are very confident that demand will grow. We're in a very interesting phase of development in healthcare, where we move from a situation of sick care to a dispensation of healthcare, and I'm going to talk a little bit later more about that. This is just to confirm demand that you will see in America by 2050, almost 1/4 of the population will be older than 65, and on average, they claims almost 7 times more than people below the age of 60, 65. So strong demand. The other point in terms which is very important is how stable was healthcare and healthcare expenses over the last 60 years. And here is a graph that shows the escalation in healthcare expenditure from 1960 to 2020. And you can see the constant growth in expenditure, and in the last couple of years, even exceeding the GDP growth. So a very, very stable industry, even in the GFC and very difficult times, you know, there was a constant rise in healthcare spending. Will healthcare be isolated from what's going on in the world? And there's definitely disruptors that will also affect healthcare. And here we talk about tech invaders. There's a lot happening on vertical integration in healthcare, where you integrate from primary health right through hospital systems. There's a lot of consolidation that's taking place in the market, and there's always also new entrants, which is the medical retailers that are trying to enter into this market. So we need to look at this, and we're absolutely convinced that we will go from a dispensation of reactive care, which is imprecise, to a proactive approach, to a preventative approach, and eventually to prediction. And, you know, this will not just add years to your life, but life to your years. We really study these trends and understand them and work with the best and most professional experts in America to help us really to understand the implications of the bigger trends on our buildings and on our returns. If we look at what's happened in the market, we believe that we need to markets that will be very resilient, and therefore our focus is, as Justin indicated, a hyper focus on medical office blocks, and I would like to call it technology-driven medical office blocks, where our tenants are people that's on the forefront of the technology developments and breakthroughs, and therefore we believe the future is secure. The other area is the blue star that you see on the left, is the acute, subacute care of care related to rehabilitation and recovery in cases where a person's health was temporary or permanently compromised due to an accident or whatever other reason. We believe those services will never be replaced by anything else. If people, a person is in that position, they need the care, and those facilities will be very, very stable. Post-acute facilities is one of the new areas that we would like to focus in. Longer term, we believe life science and biotech, with all and the latest breakthroughs in medical technology, is going to become very important. So what is the trends in healthcare? We believe that digital medicine is here to stay. They've spent in the US $37 billion in 2019, and you will see it all over the place. In terms of wearables, in terms of technology that will gather information about your health on a daily basis. We're all aware of those in terms of your iWatches and a lot of other technology in that regard. What does it mean? That means access to healthcare will be immediately, it will be anywhere, anytime, and it will be a lot more cost effective. So yes, we are very aware of the fact this might have in terms of our primary care facilities, in terms of emergency care, and therefore we've put restrictions on the number or the percentage of our building that's occupied by these type of services. We are absolutely convinced that competition will increase. Attention to patients will be very important. The value proposition will have to be looked after, and people will look for that. And, all diagnoses will be based on a proper health profile. And all of this is then features that we look in and want our tenants to provide to the market. Control of data will be very important, and that's also something that we take into consideration when we evaluate new opportunities. Thank you, Justin. I hope this gives the investors an overview. There's a lot more to it, but this is just the basic stuff that we evaluate and take into consideration when we look at new investment opportunities.
Hennie, great. Thank you very much for that. I think a question that I just have to pop to you. I know that people already listening that have been around for a while have heard you say that over the 30 odd years that you've owned these medical office blocks, you have never had a tenant, in fact, that's defaulted. This is obviously an extraordinary situation. And can you give us some idea as to how this is affecting your South African portfolio?
Yes, I think this is a very unique situation we're in. As I've indicated, over my whole career, I've never seen any other, downturn of difficult economic circumstances that affected, medical service delivery and demand for medical services. This is a unique situation. In South Africa currently, we've got hospitals that's absolutely congested with sick people, and they've moved a lot of the operations from the big hospital groups to our facilities because they need to make beds available for these very, very sick and corona infected patients. So in general, There are some of the operations that what we call the scheduled operations that's not absolutely emergency cases that will be postponed, and it will have an impact short term on our facilities. But in general, as I've indicated previously, demand for healthcare services in the long run will continue to rise and will always be there and will be a sustainable source of income to our tenants.
Justin, if I can just jump in here and just mention to our investors listening online that we have one building, Medical 25, which has a tenant called Life Hope Labs. And Life Labs basically has been appointed as the first laboratory to test coronavirus patients in Atlanta, Georgia. And so that is one of the tenants that obviously see an enormous influx of business. They're also the same tenant who's going to be moving into Medical 26. So you can see how even in this world of crisis at the moment, certainly there are aspects of healthcare that will continue to be deemed essential services and will certainly be the beneficiaries of what's going on, as unfortunate as it is.
Thanks a lot, Marty. So on to Medical 27, guys. This is a very exciting deal, and I think Machiel will get into a little bit more detail, but what we've effectively been looking for is we're looking for something that is even more recession resistant, considering that we, a few months ago when we embarked on looking for the next building, we realized that there was going to be some sort of recession coming up, and what sort of assets should we be trying to acquire for our investors. And so the focus took us to this inpatient rehabilitation facilities. And we managed to start negotiating on this a few months ago. Machiel has been very busy on it, and that has been complicated by the fact that he can't travel to the US. But I'm going to switch over to Machiel. For those of you who don't know Machiel, he is obviously our funding and acquisitions director. He spends an enormous amount of time normally on an aeroplane. And he is our resident engineer, as I mentioned. If it was up to him, we wouldn't have a slide deck. We just have a very large presentation of spreadsheet. And so, Machiel, after that abuse, over to you.
Thank you, Justin. Thank you for that. Ladies and gentlemen, it is my pleasure to introduce not only the next segment of expansion in the medical sphere, but also this new exciting opportunity. So to this end, Justin, can we look at the slide specifically for the inpatient rehabilitation center, and let me dive into that for the investors. Yeah, investors, on first glance, it's maybe a little bit complicated, but I'd just like to take you through it. If you look at the top of the slide, you'll see there's an acute hospital. And this is the normal big hospitals that all of us know. And normally, for instance, if you had a double knee operation, ideally you would like to get the op and go home. But that's not always possible. And normally there is, after you have been discharged from the hospital, you can then be taken up or helped to recover by additional facilities. So when you look at the spectrum of what they call post-acute spectrum, you will see that on the one side, home care or home health is really where a patient gets help with a professional medical service provider at the home, to a skilled nursing facility, which is predominantly a very late stage in life facilities, the inpatient rehabilitation facilities, which we're going to talk about, and hospice is really end of life taken care of. And normally, if you're really sick and you still actually need to be in hospital, almost on permanent care, you're in a special hospital, which is called a long-term acute care. So from that perspective, the inpatient rehabilitation center is really the focus of, let's call it, fairly normal patients that need additional help. And the typical stay in these hospitals are typically 12 to 37 days. People normally don't sleep over in these facilities. They are really just coming for very specialized rehabilitation. So Justin, if we go to the next slide, people would be able to see typically what these facilities are all about. It's normally when you have to rehabilitate.
Yeah, maybe I can add a little bit of color here, Machiel. So many of you might know that I had a skiing accident some 11 years ago, and I experienced one of these rehabilitation centers personally. I spent a good 5 months in the rehabilitation center in Durban. And to give you an idea, first of all, it was full. So there was no inpatient rehabilitation in KZN at all in South Africa. I had to wait in a ward in the hospital to be rehabilitated. What happens is they're real patients in there on a gurney that can't even sit up, and through a process of physiotherapy and training, they obviously rehabilitate you. Spinal cord injuries, stroke victims. I watched all these people coming in, bicycle accidents, with really completely incapacitated. Two things struck me. One, my medical aid was paying in the region of 40 to 45,000 Rand a month. I was in a shared ward, so you've got to think about the 35 square meter room that you're in with 2 other patients, and you have shared nursing and obviously shared physio, etc., etc. And I sat there and I just thought, this is the most incredible business that these people are running. So there is no other way. You can't be sent home like that. You cannot be kept in hospital like that. It is completely imperative that you have that treatment, and someone is going to pay for it. In the South African case, many of the accident victims that end up there are paid for by the state, but ultimately someone has to pay it because they can't keep you in the hospital and they can't release you. So I'm a bit of first-hand information there.
And Justin, just to add to that, one of the things in America that I can witness firsthand is that the moment you have any kind of operation or procedure, the one thing is that we focus on medical office buildings and outpatient facilities, because the one thing they want to do is they want to get you out of the hospital as quick as possible, because the costs to keep you in hospital are just way too exorbitant.
Yeah, no, thank you guys. I think that is good. Yeah, the tenant in this specific opportunity is the national leader in this type of facilities. And you can see it's by far the largest player here. And that's why we're very comfortable to go into this deal. Next slide, please. One more. Yeah, I think here gives a bit of a glimpse of how, just one slide back, please. Here gives a bit of a glimpse how it looks like. I think the emphasis on this is really the rehabilitation, as we heard firsthand from Justin. And the whole idea is really that these facilities, as you can see, really requires the patients to be physically there. So if we translate this to a strategic perspective from an acquisition perspective, I think we as OrbVest, as you know, are very focused on medical office buildings with a future stream or income stream that is future proof. So from this perspective, the inpatient rehabilitation center is very, let's call it, there's very high barriers to entry for, as Hennie calls it, the tech invaders. That means that this will be very difficult to replicate on the internet with a cell phone, because you as a person that's the patient physically have to be there. So this is one of the key attractiveness of these facilities. These facilities in general has a very long life cycle. These facilities typically have a 50-year life cycle, and in this specific case, we are only just in the interim to it. Yeah, so to this end, we are going to launch what we call OrbVest Richardson Medical 27 opportunity. We're launching that, if all goes well, on Monday, the 30th. So for those investors, simply log on to our website, you'll get the information there. And yeah, we are on track to raise 8.7 million equity. Transaction size is around about 39 million. And the IRR projected is around about 12%. So I think this investment opportunity, I would like to illustrate why we're so excited about it, in the current situation. So if we maybe go to the next slide, please. It's of course located in one of our key areas in the Dallas-Fort Worth area. For those that know us, we are very bullish about this area. The state of Texas is an unbelievable buoyant state. We have researched it also in the GFC. They have been the least affected by serious crises that we can research on. And we're also in the epicenter of growth in the northern side of Dallas. So from that perspective, it really ticks the boxes of population growth. And also we've got very close access to the Dallas-Fort Worth Airport on the highway there. So all in all, from a location perspective, it really ticks our boxes. Yeah, the tenant, like we said, is a national leader. And then what's significant about this is that it is a credited tenant, which has been accredited by external parties, and it's got a 13-year remaining lease term. So that's very exciting for us. That means that this tenant has been already in the building for 8 years. The lease overall is 25 years long. And so for us, with a 5-year investment horizon, this really bodes well. And also in this specific environment, this facility has also been very clearly earmarked to help with the let's call it the support for the state with the advent of the virus. So from all in all perspective, this facility and the actual location is very well poised to maintain this long-term lease. Okay. Just a bit of the figures. We are going to structure the deal with senior debt. You can see the debt coverage ratios, etc., is extremely lucrative from a cash flow perspective. We are going to employ a ground lease. Really, in our experience, this is one of the best defense mechanisms that we've seen from our partners with 3 times through crises like we've seen. And as you can see, our partner is also going to contribute into this specific deal. So from that perspective, a fairly standardized deal from our perspective. Purchase price 37, so it's a sizable transaction. The sellers are also aware of the current situation, and they've been very accommodating with us in the period that we are going to go through now, which is our due diligence period. And we have started with some very special measures to deal with the normal processes to evaluate the building, and also to deal with the lockdown, like in South Africa, like in Georgia, like in New York. Texas has also had a lockdown, but fascinating enough, our lender, which is in this case going to be Siemens, has been very proactive in giving us measures of how to deal with the situation during this time period. And to this end, they very clearly are going to fund this deal for us. The projected interest rate is going to be 3.1% or 3.2%, depending on the final numbers. So this is super exciting for us. The reason why that is so exciting is that our previous deal we closed at 4.7%, and this will obviously capitalize on the low interest environment. So from that perspective, we will lock this rate in so that it will not be able to go higher, and therefore we have the upside risk cover on the interest rate perspective. Then going to the additional risks, Justin, on the next page, yeah, of course the tenant risk is our number one risk in this case. The investment committee, after a long deliberation, was very clear. This new sector bodes itself extremely well for the single tenant credit. As you would have seen, this tenant is a New York listed tenant. We've seen the financials of the facility. It covers the rent 3.5 times of net profit. So yeah, we've done our work already on that, and we are going to obviously do our final work now in the next phase. From an interest rate perspective, I think we have covered that. So that's very clear that we are going to lock the upside of the interest rate hike, and we have the special tool that allows us still to ride the interest rate if it goes lower. So very, very nice tool that our partners is helping us with. And then, of course, the valuation risk, meaning are we not paying too much for this asset? We've researched it extensively with our broking partner, JLL. As you would have known previously, we have vetted our real estate strategy with them late last year. And they gave us full thumbs up. And as a result of that, when they saw what we're doing, they actually brought this deal for us. So yeah, from a valuation risk, we're very comfortable that our strategy is 100% in line and has been checked by one of the biggest real estate brokers in the United States. With regards to the ground lease has a very interesting characteristics that it, first of all, shrinks the capital stack that is liable for, let's call it a refinancing. That means that in time, when we would like to sell or somebody like to buy it, a large portion of the capital stack is not subject to refinancing. That makes it a less risky deal for a tenant or for a buyer to buy. And then secondly, Siemens in this specific case will be then actually subordinate to the ground lessor. That basically means that the ground lessor will actually help keep the bank in check. Not that we have a problem with Siemens as a lender. We have already got experience with them last year April with Medical 14, and they've been extremely cooperative, and our relationship is very strong with that. So from past experience, we've seen that this is really a tool that helps to make the deals very stable. And we as a team with the investment committee has already started evaluating all our deals, to look at exactly this potential of risk. All right, so Justin, I think that's the risk. So yeah, I think why we're so absolutely positive on this opportunity. This is a solid cash flow deal. It's one of the bigger, has got the biggest operator in the United States for this type of hospital. It's a triple net lease. Actually, I would actually just like to call it a deluxe triple net lease, because in this case, we really have to do almost nothing. Not that it's nothing, but you don't have to spend any capex or any maintenance at all. This is a fully turnkey lease, and that's very attractive, obviously, for us because it minimizes our risk. And then I think very importantly, we planned this to help this for 5 years. And the reason why it's such relevant for this term is that the next escalation of, not the next, the final second and third escalation of the lease will be very close to the selling time. And it means that if we position our sales price so that a potential buyer can actually buy it with having the benefit of that increase in February of year 5, with the 8-year remaining term, this becomes an extremely attractive offer. So that is the business plan that we would like to do. And then I think lastly, but certainly the most important for us from an OrbVest perspective, and we believe that it's got a solid cash flow as a defensive deal. You'll see when you look at the returns, it is definitely not shooting the lights out, but in this specific times, the whole idea is to have an opportunity to place your money where it's a solid return. If you've seen the carnage on the market, you would have noticed that the equity market obviously had a very large drop, and people that traditionally have been in the equity market has actually tried to withdraw their cash, and hence the large drop. But the other side of the coin is normally investors would like to put their money either in a bank or in a bond. But if you notice, the bonds in the US is close to zero at the moment, and therefore it doesn't offer an alternative. So really, let's call it the real estate class that we are in offers a unique opportunity for safety in this times of uncertainty, and also where to place cash if you need to have income while the market is turbulent. Yeah, so to this end, conclusion is that it's really an end-to-end product for our high net worth clients, offer a very clear, stable annuity income, provides us diversification in the US market. So like we've been clearly telling our clients that if you invest in multiple of our projects. You can really diversify your projects so that you're not very sensitive to a specific project. And yeah, I think the other side of the stuff is when we do these deals, it's definitely not a development. It's already got income, and it is a going concern from day one. Yeah, so all in all, Justin, I think that's it from my side. So I hope it came very clear that we are positioning this product specifically for these type of markets, and that's the whole emphasis and focus for us at the moment.
Machiel, thank you very much for that. And I'm sure there'll be quite a few questions. Guys, we do try and keep these webinars to 45 minutes. We'll end with a wrap from Martin. In the meantime, I'd like to go to some Q&A. And for that, I'm going to stop share. And we will go to the Q&A. So I guess... guys, if you want to bring in your questions, there are not many questions to this point. Machiel, the big one is we have obviously done some due diligence on how our tenants are performing at the moment. And I think the big question on everyone's mind is, do we have any defaults at this stage? Is Hennie's view that medical don't default really a factor now? And what is the actual data telling us with regard to our existing tenants across America?
Yeah, Justin, we as part of our team member, part of the asset management group has started this process. We've started to interview every single people or every single tenant through our property partners to understand the situation. The message that we've got back is that there is very clear and a widespread of essential services that has been designated that has to continue during these times. For instance, the treatment of cancer in some of our buildings has to continue, as it's a less riskier place than to actually go to the hospital according to certain views. So on the one side, we've seen consistent that our medical practices have to stay open. We have also got the case where the dentist has been ordered by the national government to make the capacity available for emergency capacity. So the dentists have been instructed to close if the state needs the facility. So at our current one tenant in medical 24, he's a dentist. He's continuing to practice, but he has the government has not yet called on him. And then, yeah, we're monitoring closely. We do expect one or two of our tenants that will definitely ask for, let's call it relief to pay their rent later. The United States has also, for commercial landlords, has announced a huge incentive package to try and cater for this. So yeah, I don't think we will be unaffected, but I definitely think the majority of our tenants that we screened already this week are continuing. The second thing is that we also know that most of our clients, like Hennie outlined, is 93% of them are on Medicare or on private health insurance. And I think Martin can also just confirm this, but there would be under no circumstances any patients will be denied any service in these times unless it is deemed to not be a crucial service. So if you know, most of our facilities has got surgical centers in, it's got people that's got drug-related problems, it's got a whole wide range of things which we believe is essential, and essential services will continue. And then, of course, one or two of our tenants has really been favored by this whole situation. The Life Hope Labs in Medical 25 and also going to be in Medical 26 has been at the forefront of testing. We've seen now they have set up a complete test ground in the church ground. They're doing something like 1,500 tests a day already. and this is being processed by a lab, which is one of our tenants. So yeah, a bit of a mixed bag, but overall it definitely seems to be positive. This will obviously be monitored on a weekly basis, and as soon as we have relevant data, we expect to communicate roughly every 2 weeks or every month on the situation. And our next major update will be part of the project review packs that's going with the quarterly distribution in April.
Justin, I think if I can just jump in here and just say the following.
Just hold on a second, Martin. I'm going to come to you. Great question here from Hilditch, and it's about strategy. So it is your question anyway, Martin. So what is OrbVest's future? There is a lot of competition for deals. Machiel, you've experienced that. Cap rate compression certainly going up to 3 weeks ago was a factor. And her concern is with this 5-year period that we retain the building for, is that something we are going to maintain? She does mention that, that you have spoken about longer investment periods. And the question really, Martin, I'm going to swing it to you, is our strategy only to hold for 5 years, or are we going to look at holding on to these great assets for a longer period of time because of the value in the building? And why do you go to all the time, trouble, and cost of acquiring a great asset and then selling it early and passing on? Thank you for that, Hilditch.
So the first thing I just want to talk about is the tenants. And so if you were looking at retail right now, you were looking at multifamily. We know that there's tremendous concerns in those two asset classes at the moment, because you just don't know in 60 days or 90 days when the world comes out of this, how strong your tenants are going to be. You know, I have someone in New York whose brother-in-law is an orthopedic surgeon. He may be sitting at home now, but he said to me over the weekend that all his clients are still going to need the same procedure in 8 or 9 weeks' time. So we are very comfortable that our tenants are very strong financially and with very strong reputations. So I believe that they will still be very resilient, sound buildings. That's the first thing. The second thing is from an acquisition perspective. OrbVest does not try and acquire buildings in the open market, because everyone's bidding for the same building and you're liable to overpay. Our strategy from the very beginning has always been to build a network in America, and we try and acquire off-market transactions. Why off-market transactions so significant? Because you get them before anybody else does. People are also very happy to deal with a company like OrbVest that has never not fulfilled a deal, going on now 6 years. And so we really are getting an amazing reputation. Regarding the tenure of the building, you're investing to generate dividends and you're investing to generate a profit. So we need to always ascertain what is the ideal time to sell a building. And as long as you can sell a building and deploy your capital into another great opportunity and make the profit, that's the balance we try and look for. So if you were to hold this building, for example, for 10 or 11 years and try and sell it with only 2 years potentially remaining, you might not get the value. Hence the reason why on a 13-year amazing building in a great location with good dividends, after 5 years, I think you'll have a lot of buyers lining up to buy it. Having said that, you then ask the question about, is there sufficient buildings? OrbVest is currently acquiring a building every second month in America. That means 6 a year minimum. And given 6 a year across every state in America, there's more than sufficient opportunities. The main reason is that all the REITs in America generally do the same thing. They hold their buildings for 5 years and then they sell them for a variety of reasons. And so we actually have a very strong pipeline at the moment right now. But as we say to people, you've got to get in somewhere. Start to invest, get your money in, put a small amount into every single building, and after 2 years, you'll have 10 buildings in America and a portfolio in the healthcare niche. Hope that answers it, Justin.
That's it. Thank you, Mart. Machiel, over to you. Mike Stein, he asks for an illustrative example of projected returns on 10K. Mike, my apologies, we seem to have jumped that slide. I'm going to load it at the end of the Q&A. Bear in mind, we're already at our 45-minute cutoff. So if you just hang on after that, I'll load it for you. But the second part of the question, Machiel, is what are the tax implications of funds being repatriated to South Africa?
Yeah, the question is that if the investor is investing on the platform, which means that he's investing in the listed security that we have on the merge platform. That is the channel 1, as you illustrated right in the beginning of our presentation. In that specific case, the investor would be able, every time he receives his dividend, he will then be liable for a 20% flat tax rate. In South Africa, it's very similar worldwide, that the dividend tax rate in most jurisdictions are between 15 and 20%. So, Mike, it basically means that irrespective if you are one of the lucky ones that's earning in a top bracket of 43% for normal income tax, this specific income is declared in the type called dividend, and as a result, it's only applicable to dividend tax, and that's a flat rate. So it's a very attractive situation for investors, so that they don't have to have a scaling tax rate based on the size of their investment. So yeah, to answer that, I assume it's a South African that does it, and that's the context in which I answered it.
Thanks, Machiel. Good answer. Hilditch asking a very good question here that many of us are facing. So we're all sitting with rands. We know where the rand is right now, and now we want to substantiate taking our rands out of the country, hiding in terms of exchange rate. Martin, this is coming for you, so get ready. The question is, how do we substantiate, and is this deal attractive enough for us to actually do the investment now, or do we wait for the exchange rate to improve later on down the road? Martin, over to you.
So we have always had a consistent message for South Africans. You're never going to guess the rand. You know, we've seen the fluctuations up and down. We do know over time that it will consistently depreciate against the major currencies. We've had investors coming in at 12, 13, 14, 15 over the years, and every year they've asked us the same question. What we've always said is, as long as you are consistently investing into every building, you will end up at an average, and if it gets worse, you'll still be better off, and if it gets better, you'll still have average. But remember, if you look a year down the line, or 2 years or 5 years down the line, you know, there is every logical scenario that says the depreciation certainly won't see it improve. It's liable to stay the same or get worse. And again, as long as you're building for long-term wealth and dividends, you're going to get your 8% per annum. And then when you sell, you're going to get also a profit, which means that you're going to be earning as a minimum 10 to 12% in US dollars per annum. And I always say that when I was in South Africa, I was told by the banks, you can't achieve those kind of returns. And you should be thankful if you get 5, 6%. That's simply not true. We've got thousands of investors that earn these kind of returns every single year. And it's just because we also are privileged that we can generate great deals and have a South African overhead infrastructure against the US dollar dividends, which means we're in a very efficient organization.
Good question here from Leon. Thank you, Martin. Machiel, for you. Remember that we are in a situation where equity raise will be slightly delayed. The question is mid-27, when will we close and when will we start earning dividends? Will there be a delay?
Yeah, the question obviously is $1 million question. And from our perspective, we have tried to build this in our plan with the seller. So in general terms, the deal is going to raise the money in roughly 90 days. And this is the time period we've got. However, based on the current scenario, if there is exterior circumstances that we need additional time, we have negotiated that that would be possible, and we will extend the time if that is needed. But all in all, we believe that there's now adequate time to do our due diligence so that we can still raise the equity, but maybe not as fast as we would have. But we can do that in about 3 months' time for this specific deal.
Great. There's a question here from a new investor saying, how much do we have to invest to get in? And the answer is quite simple. We obviously have a very high reinvestment rate. We encourage investors to come in and test and taste. And once you start to earn your dividends and you start to get onto the platform and see your little dashboard and see the gamification there, we feel that we will get you to invest more later. So the answer to that question is $5,000 is the minimum, and we're pretty sure you'll come back for more later. Liquidating your investment, quick one. Machiel, if you want to exit early, because this recession dragged out over a long period of time and you do want to get hold of your cash, what's the chance that you can sell your shares? And I guess maybe you can give us a little bit of history.
Yeah, our history with regards to what we call the secondary market has been extraordinary, in the sense that once investors actually have seen that it's a good asset, and one of the investors would like to exit early, they would offer it at the willing buy, willing seller price onto the market. And our experience to this date has been that it's normally taken up extremely quickly, because investors that's already in the deal obviously will have first pick or will have first notice of this. Yeah, so if the idea is really not to do that, because you will not really receive the capital growth in that instance. You would really, most of the cases, people have received their initial capital back, maybe a little bit of growth, but in essence, it's a little bit not to your advantage to sell earlier. However, life happens, and we've had that, and people normally take up the shares quite quickly.
Great, thanks, Machiel. We're going to stay with you, and this is a great question from Peter Nell. I'm going to make this the last question before Martin wraps. So Peter asks, can you give us a comparison between Med26 and Med27? So if you were a new investor, bear in mind we still do have some equity left in Med26, and that's closed already. So you would be earning your money straight away. But talk about the risks of the two, talk about the opportunity, and perhaps the fact that you've got, whatever, 90 days before you start earning your dividends on 27.
Yeah, so how we normally evaluate deals is really by virtue of two things, or actually more than two things. So let me start with the internal rate of return. Normally you will see in the specific case, Medical 26 internal rate of return are definitely higher than Medical 27. The main reason for that is that with Medical 26, we are adding a lot of value to the building. What does value mean? Value means that we are taking a 20% vacancy that was not filled when we signed the purchase and sale agreement. We have subsequently filled the full 20% virtually. I think there's like 3% left. And that basically means that the income of the deal has significantly increased over and above the purchase price. So we've added a lot of value, and we've also added the value in terms of the level of rent. The current rent rates are typically $25, $22 per square foot, and some of the tenants that we included, like the Life Hope Lab, has been roughly at $35 plus. So it means that with Medical 26, we will definitely have a higher capital return, and the tenant mix are diverse. However, there is risks to it. We have 2 or 3 tenants that has to renew, and we've planned with that in our cash flows. So from a return perspective, the returns on Medical 26 is higher, whereas if we compare it to Medical 27, the intention of Medical 27 is really to get a solid credited tenant as the source of your cash flow. Therefore, in this specific case, there is no vacancies that we can fill. We cannot do any additions to the building. So therefore, the real value here is the fact that we have purchased it at the right price and that we have the escalations in our rent. So to position this deal is really an income-focused deal and in trying times. And that's why we believe that this type of deal is correctly positioned for this type of situation. Not to say that Medical 26 is bad. It's really just a little bit different focus from the one to the other. And like we always have said, you have to basically make your choice on this. And remember, one of the rules that we always focus on is really diversification. So you know, I would not recommend putting everything in one deal. Rather spread your investments if that is something that you decide to do. Thank you.
Thank you very much, Machiel. We're going to end the questions there. Sorry if we missed anybody out. Perhaps we'll get back to you directly. What I would just like to do, Machiel, is perhaps share the presentation again and show that slide that you can talk to. We will find it on.
Yeah, I think to answer the question with return to income, you'll see that in this specific case, the income is virtually solid for year 2, year 1, 2, and 3. And then it escalates in year 4 and 5. This is very specifically the nature of the lease that escalates every 3 years, and it's got a CPI correction factor. And we've also structured the debt to follow suit. So that's the returns, as you can see it in the US investors. That means that you get your return to an LLC. The IRR is 12.19. And then for the international investors, you'll see the capital growth is only about 14%, which is the escalation translated into the capital growth. And then the IRR in this case is 11.07%. But mostly importantly, which we are so excited about, is you are getting a return of dividends at 8.6 plus level. Guys, that is phenomenal in this timeline, especially with a Moody A-grade tenant behind it. So this is the attractiveness. It's really when people are looking for cash, they need income, and they can get this in a very efficient way, either as a foreign investor with the 20% dividend tax, as I explained earlier, or if you are a US investor base or an international investor that would like to invest via the US LLC, that has got a completely different tax approach, and you have to consult your local US tax guy for that. But in essence, you'll see the main difference between the two returns is really on the last end. In the US, when we take the final monies out from the US to the offshore, we have to pay the withholding tax. So it means that this channel on the offshore perspective really takes all the complications and headaches away from you as investor. You simply have to, as far as we're concerned, do your initial investment and then don't phone us again. Just log onto your portfolio and you'll see the dividends coming.
Machiel, thanks very much for your time, and I'm so glad that you're not on an airplane right now. And so if I can, guys, just ask Martin to wrap up for us.
Well, thank you, Justin, and thanks to my team. You know, from a company perspective, we as OrbVest were already cognizant of the fact that a potential correction was coming in 2020. We obviously thought it would be later in the year, just after the election. I don't think anybody could have predicted this event. But in preparation for that, the investment committee, under the guidance of our chairperson, Hennie, was really directing the team to find us more secure, solid assets, almost in the US, what you can call a coupon clipper. It's where you get an amazing tenant, and literally it's a triple net lease, and you simply receive your income every single month. So this deal actually started in December. It's been going since then. We were actually supposed to launch it towards the end of February, long before the coronavirus became such a troublesome issue in our lives. So I would simply sum up and say the following. For anybody in the world, you know, you have money, you're looking to try and invest it, you're looking to try and keep it safe, you're looking to try and generate a return, you know, and certainly if you're able to find an asset or a group of assets in the USA, which are resilient, which are not really going to be affected from a healthcare perspective, because the one thing in the US that every politician knows, never touch anyone's healthcare benefits. And so we believe that this asset, Medical 27, is extremely well positioned. It's going to be certainly a solid income driver to people that are looking for this kind of peace of mind, safe haven approach during these crazy times. And so we're proud to be able to bring it to you. We thank everyone from around the world for coming online tonight. And thank you again to my team for successfully managing to get such a great asset into OrbVest. And remember, just keep on diversifying, investing your funds, build a strong, diversified portfolio, and focus on getting to 10 investments across different states in the USA. That is what we believe in. Thank you very much.
Thank you, everybody, and it's good night from everybody on the side. Have a good evening and stay safe.
When you were here.